Today, we will talk about inventory write-off. An inventory write-off is when a company formally recognizes that a portion of its inventory no longer has value. This can happen when inventory becomes obsolete, spoils, becomes damaged, or is stolen or lost. It can be accounted for by expensing it directly to the cost of goods sold account or offsetting the inventory asset account in a contra asset account. Inventory refers to assets owned by a business to be sold for revenue or converted into goods to be sold for revenue. Generally accepted accounting principles require that any item that represents a future economic value to a company be defined as an asset. When inventory becomes obsolete, spoils, becomes damaged, or is stolen or lost, it must be written off. An inventory write-off is the process of removing from the general ledger any inventory that has no value. There are two methods companies can use to write off inventory: the direct write-off method and the allowance method. The direct write-off method involves recording a credit to the inventory asset account and a debit to the expense account. If the inventory write-off is immaterial, it can be charged to the cost of goods sold account, but this may distort the gross margin of the business. The allowance method, on the other hand, involves recording a journal entry with a credit to a contra asset account and an offsetting debit to an expense account. Large, recurring inventory write-offs can indicate poor inventory management and may constitute inventory fraud. Companies need to be honest about the value of their inventory to ensure accurate financial reporting. Here are 3 key takeaways. 1. An inventory write-off formally recognizes inventory that no longer has value. 2. Large, recurring inventory write-offs can indicate poor inventory management and may constitute inventory fraud. 3. If inventory only decreases in value, instead of losing it completely, it will be written down instead of written off. Hope this would help. Thanks for watching.